Um, Welcome to Fundamentals for Startups, a CoMotion Labs production. I am Siri Vimonchalau, CoMotion Labs Manager for the Hardware Incubator. CoMotion Labs is a multi-industry incubator program hosting early startups and innovation from within the university and outside. We provide critical infrastructures and opportunities for learning, mentoring, and networking, and we do this without taking equity or IP. We have 3 incubators in 2 locations on campus. One right here, which is the technology incubator, and we at another location at Fluke Hall, we have the life science incubator and the hardware incubator. If you are a founder looking for a community to help grow your startup, we'd love to talk to you. Fundamentals for Startups is a regular lecture series open to anyone interested in learning about entrepreneurship or building a startup. Every week, we bring in experts with diverse perspective and experience to share insights, inspire action, and offer space for questions. A few announcements before we get started. All of the Fundamentals for Startups presentation are archived on YouTube and CoMotion websites, where you can filter them by topic. To learn about and register for future Fundamentals event, visit CoMotion Labs online and subscribe to our YouTube channel. Today, I'm excited to introduce Skyler Brown, a Foster School alumnus, who now work with ultra-high net worth individuals and families. He'll talk about how to protect potential wealth throughout the startup life cycle, from the incorporation stage through company sales or IPO. May I welcome Skyler?
Thank you for that great intro, and thanks for being here in person to everyone who's here in person, and thanks for joining us on YouTube for those who are here on YouTube. So you'll see I only have one slide. I'll explain why that is a little later. I want to take a step back quickly, recognizing the space that we're in globally. You know, protecting wealth, capital, et cetera, is just a way that we ensure that we have high quality of life throughout our lifetimes. I'd be remiss if I didn't directly acknowledge what's going on in the Middle East right now, affecting people throughout Israel. So if you are so inclined, please join me in a moment of silence for all of those who are being affected now and will be soon. Thank you. So why one slide? A friend of mine who runs an organization called the Arts Fund issued a direct challenge to every professional he knew to attempt to make things easier for people who may be living through an impairment. And so for those who may be joining on YouTube or are visually impaired, I'll describe the slide, I'll describe what I look like, I'll describe what our great crowd looks like, and then I'll deliver my remarks in more of a podcast style so that everyone's sure they're not missing out on any content. So first, the slide. As a proud UW alum, of course, we have our colors, purple and gold. It's a 4-phase slide, 4 arrows. Inside of each arrow is a term. First phase, ideation. Second phase, tangible asset creation. Third phase, capitalization. And fourth phase, outperformance. I'll get into why I chose those for the sole slide here. I am a person who identifies as a male, black male with a blue sport coat and black pants on. We have a nearly sold out to capacity crowd here of maybe 25 to 30 people. We are at UW CoMotion Labs, which is on the 2nd floor of a building that's on the southwest section of the University of Washington's campus. And so with all of that out of the way, I'll get started. These are what we believe are the 4 main outcomes for entrepreneurs pre-IPO. And why do I use pre-IPO as the point of delineation between where I'm going to stop talking while you will have likely significant additional wealth after IPO? So the problems that we're solving for post-IPO are usually time-based and less than wealth-based. So if you can get to an IPO, your firm has outperformed for such a period that one would assume you have significant value. You're having a conversation about 10b5-1 plans, how do I schedule the sales, et cetera, et cetera, et cetera. which is something that most wealth managers at that UBS, Morgan Stanley, Goldman Sachs level will be able to help with. But there are different problems pre-IPO, and that's what we're going to talk about today. So when I tried to put together something that would be beneficial for everyone who joined us today, I thought about what would I be trying to do for myself if I were in each of these phases, and I'll just take you guys through that process over the next 30 or so minutes. After that, there'll be plenty of time for questions if you have very specific questions you'd like to ask. If it's something that I can't ask here, I'll stick around for a while and make sure we get those questions answered. Starting out with the ideation phase. So ideation for your wealth is very similar to ideation for your startup idea. And what do I mean by that? The first thing you are looking for as an entrepreneur is a problem to solve. What is the problem that I'm trying to solve? And if you have a good idea of what that is, then you come up with a solution for that. It's the same thing with your wealth. So because we live in America and we've seen all of these unicorn exits, you may have a number floating around in your head. I would feel really good if my company were valued at $3 billion. Everyone agrees. That is not the problem you are trying to solve when you're attempting to protect your wealth through this cycle, though, right? The problem you are trying to solve is how do I risk manage my wealth day in and day out until I get to that exit point, if I choose to exit, or if I choose to stay at this company and run it for the next 30 years, how to ensure that I've protected my wealth throughout the duration of that period. And unfortunately, there's no easy answer there. Just like when you were ideating on your startup, there's a lot of introspection that's necessary. There's a lot of check-ins that you'll have to do with people whose opinions you value. But to be helpful there, if I were starting from scratch and I were in your shoes, I would think about three things. Number one, when I'm not working any longer, where do I want to be? How do I want to feel? What do I want to do? And if I'm thinking about those three things, it's much easier to create a valuation for where my wealth should be at that point and work backwards. So what do I mean by that? If I want to live in Enterprise, Alabama, and fish every day, and I don't have any kids, then I won't need as much capital as if I want to live in Capitol Hill. I have 5 kids who I want to send to college, and I want to go to UW every day and be an adjunct professor, right? So I want to take some time now, just a quick 30 or 40 seconds for you guys to just briefly think about those things, not from a numbers perspective. And for those of us who are on YouTube, please join me in this. What do I want to do? Where do I want to be? And how do I want to feel? Just think about that for a second. And I'm going to follow up with a question for someone from the audience. Let's take 30, 40 seconds here. Okay, a little uncomfortable, but that's okay. That's what we're here for. Can someone raise their hand and give me their answer? Someone who feels comfortable doing so. No wrong answer? Okay, go ahead.
I would love to be retired by the age of 50. I'm not
Okay.
planning on having kids, so
Okay.
being with my husband and in Seattle, a place that I guess now would be considered an average home at $1 million.
Right.
And hopefully able to travel around and not feel constricted by money, but still feel like I can have an impact on my community and the environment by being able to donate or participate from a monetary perspective without feeling like I need to worry about that.
Great answer. Thank you for sharing with everyone. And so it's more difficult for some people because they've never thought of it, but that is the holistic answer that you would be able to assign dollar values from, i.e., I only like traveling in Asia. I like to travel once a year. I'm going to draw that out to, let's go with 30 years from now for you. I'm going to adjust that by inflation, right? Then I'll have a nominal value, and then I'll backwards plan from there. And so when you're doing that, you'll find that in the ideation stage, It's actually much more easy to come up with your end goal if you think about your end goal with verbs, right? What do I want to be doing? How do I want to feel? Where do I want to be living, et cetera, et cetera. So there's the first step in ideation. The second step in ideation is how do I tangibly get there and who should be on my team helping me? So for many of us who aren't extremely wealthy already, you probably don't have a CPA or an estate attorney, but I'm sure everyone who's in this room has a board of directors, right? People who give you advice, people whose advice you respect, who may be working in the industries that could help you with professional advice. There's also something called 1 degree of separation. So as an example, many of you in this room have founders who have had a successful exit who are your mentors. What we don't generally think about is, why wouldn't I ask my mentor founder to tell me what his CPA or her CPA would have told them if they needed help with this problem, right? So if you can't actually afford the services right now, is the University of Washington, maybe it's 1 degree, maybe it's 2 degrees removed, but you do have access to that professional advice through your network here, and that's one of the benefits of being associated with CoMotion Labs. Short of that, though, there's always the internet, but I would caution you there because the internet has a lot of great information that sounds good that may not necessarily be timely and correct. So what are the 2 things that I would do for myself if I started from scratch and was just in the ideation phase? I'll put a little bit more color around where I am. I would assume that I was working some other job while I was ideating. And for myself, since I do have a family, I'll assume that I have a family as well. So during this entire investment process, your investment team is going to be thinking of 2 things: risk management from a security perspective, and that is protecting against the downside, and risk management from an upside perspective. If everything goes well, then I've done the right thing. And generally, everything doesn't go well, as you all know, as entrepreneurs. So we always want to tamp the upside outlook down a little bit. My first 2 moves would be, number 1, considering life insurance. So this is not a regular financial advisor's advice because they don't generally get money from that process, right? But for you, if you are attempting to protect the value for your family or whoever you hold dear through the full life cycle of a startup, you are dealing with the classic problem, which is, if I'm the entrepreneur with the best ideas and an accident happens, then my company loses its value, and what does my family get, right? So there's my first consideration, is for my family or people I hold dear. If I need them to have some amount of value, if I'm no longer working, if I come out of this cycle, what should I do? That's life insurance. And number 2, if you are fortunate to be working at one of these Fortune 50, Fortune 100, Fortune 1000 companies that I can throw a rock at from this room, what is the best investment vehicle that's available to Americans right now with the highest returns? It's your 401k match, right? For every dollar that you get matched, it's 100% return in the moment. If you've had someone look at your 401k and it's at least a little diversified and you didn't put it all in Dogecoin, right? You can generally guarantee that over the lifetime of your investment, the 100% return you got from your company's match is going to grow parabolically over your lifetime. So those are the 2 things for me in the ideation phase that I'm thinking about. Number 1, some sort of insurance if there are people that you want to take care of after you're gone. And then number 2, what are those areas where I can get outsized returns through the infrastructure of the investment? And for most of us, that is our 401k. Another area that you should consider is the IRA, whether that's a Roth or Classic. There are certain bets you're making on taxation there, which I'm happy to get into offline with you, but there's another way to, over the lifetime of not just your life cycle, the life cycle of your startup, but your life cycle, set aside value for those you care about and for yourself. So there's the ideation phase. Now we have the idea that's merged into a tangible asset. And what do I mean by tangible asset? Now we have lines of code, we have a factory, whatever it may be. The startup is no longer in the ideation phase. You've likely had some sort of incorporation and you're moving towards getting revenue. At that phase, you should absolutely be thinking about QSBS or qualified small business stocks. So what that is assuming you are in the tech space, I'm sure you've heard of QSBS, but it's going to help you invest or your investors invest up to $10 million and up to 10x that initial investment amount, as long as the capital value of your firm is not over 50 million, will be protected from capital gains up to 100 million. So going back to your first degree separation experts, if you don't have access to the type of CPA or attorney that can tell you whether or not your company is eligible, that is absolutely something you should be looking into. Now, as we move further down the line and your company gains more value, we are absolutely at the place where you're looking at the secondary markets for sale. You're looking at total valuation and how much your stake will be worth. And at that phase, you really don't want to hear something like, well, if you just incorporated it slightly differently, none of this would be subject to long-term cap gains, right? So first degree separation advice, very important during the tangible asset creation stage, because the tangible asset can, in many cases, be just your company incorporation. Okay, so back to the team. If I were in your shoes and we're creating this asset, I am absolutely looking for some sort of attorney to be able to help me along the way. And then as CoMotion Labs has constantly talked to you all about, I'm also looking for mentorship, right? And in that mentorship, there are generally two kinds. There's the type of mentorship that you have based off who you are, your network, people who are very interested in you succeeding. And there's also the type of mentorship that will require space on the cap table. So this is another area where we see over time, entrepreneurs need services, and if they're able to value their cap table appropriately, they can make the right decision on how much of the cap table they should be giving up in order to get an advisor who may help them with knowledge or help them with something that actually grows their company, right? But if you are not one of those people, then we are right back to where we were in the ideation phase with that first degree removed advisorship. So you're coming to a place like this, you're asking your network, hey, this advisor says they have access to one of the largest e-commerce shops in the world. They can connect me directly with people I need to connect with. How much cap table space should I be giving them in order for them to advise me? That answer depends solely on who you are and the value of your company. So again, we're discussing frameworks here that can be helpful. And in order for your board of directors to be helpful for you, they need to be able to also have access to this type of information, right, to help you make the right decisions. So anytime we overpay on the cap table, when we get further down the line, capitalization, outperformance, that's value that we no longer have access to. So there are two trains of thoughts here. One is, who cares if we get further down the road? That's value that we wouldn't have had anyway without the advisor. But the other train of thought is, if we just take in the hour or two to have a conversation, then you get both, right? You get your risk-adjusted cap table space moved over, and then you also get access to the asset. So again, I'm looking at people who can, at a professional level, give me advice, at least 1 degree removed from my own network, A. B, I'm trying to build a team that is looking at, if I am successful further down this track, what are the things that I should be looking out for? As an example, Washington State just had a capital gains move from 0 to the proposed 7%. So if they're having that conversation with you and you're in Series C today looking to liquidate, it would be very helpful if someone could tell you, hey, if I were going to sell at the same value this year or next year, here are the potential tax outcomes. So again, hopefully at least 1 degree removed or in your personal network. But those are the types of outcomes that I'm looking for my team to be able to provide for me. So what have we talked about so far? In the ideation phase, if you're generally working at a company and you have some sort of actual recurring income, then life insurance and infrastructure matches or infrastructure that saves in taxes are the types of things that I would be looking for. Number 2 is you create your companies and you begin creating the things that will create the demand signal to enrich your company. That's what I'm looking for. Very specific professional advice. Number 1, to maintain as much space for me on the cap table as I can, while also having access to those assets. And then number 2, I'm looking for those outperformance indicators, right? If I am very successful, if I have a Series B lined up, what should I be thinking about in terms of tax outcomes? And then the other thing is estate income. So I'm not trying to be a downer here, but these are things we see in my line of work regularly. And the estate outcomes are basically an outlook on where we put our assets, who owns our assets, and who can administer our assets to others in the event that we are not there, right? And that could be due to injury, death, but that could also be due to tax savings, which most people are interested in these days. To have those types of conversations, you'll likely need a group of people on your team. That is the CPA to help you figure out the tax consequences of making these types of trust and estate decisions. And that's usually the estate attorney themselves as well, who will be able to give you the best access to infrastructure. So this area of tangible asset creation, for those of you who are looking to outperform, having those conversations early will save you a ton of grief later because you'll set things up correctly the first time. So again, we want to make sure that our assets are resilient to taxes, market moves, and then we want to ensure that our wealth is resilient even in the event that we are not there. So moving even further down to the capitalization stage, and that's when you are taking on debt. You have people who are actively staking you, and you're watching the asset value of your company grow significantly over time. This is generally when people start to shift out of the index style 401ks, IRAs, etc., and start looking for someone to help them risk manage the exposure that they have as a startup founder to their company's equity, risk manage that against and with the basic capital markets. So your stocks, your bonds, and private equity. So as we can see, as we move down the trail here, our team of experts has grown. We started out with nothing. Now we have a CPA, now we have a state attorney, and maybe we have a wealth advisor. So I'm gonna go back to the start. Why would I, as someone whose actual profession is a wealth advisor, if I were in your shoes, actually have someone who's helping me? Now this may be a paid position, this may be someone in my board of directors, but the facts are there are only so many hours in a day, right? And while you all are running your companies, the markets are extremely volatile. So those of you who were actually invested through coronavirus saw extremely different outcomes based off whether people put all their money in cash too late, or they invested and stayed invested and then crystallized the losses when they felt like it was an intractable situation. And then you also saw people who, at the end of March, went all in on the markets, right? They had good indicators, they had faith, et cetera, et cetera. So whether they're paid or not, because there's so much volatility in the markets, it would be helpful for you to, at minimum, look at two things. And that is, A, my company that I have capital in, how resistant is that to market moves? And if it's extremely resistant to market moves, i.e., you are one of two major American companies who are producing masks in the middle of coronavirus, then you can afford to invest completely differently. If you are not in the case where your company is extremely resilient despite market movements, then it's probably a good idea for you to consider diversifying a little bit of your risk out of your company and into a diversified portfolio. So why do I recommend this? It's twofold. As you look at the normal distribution of outcomes for an entrepreneur, unfortunately, not everyone ends up on the right tail with the unicorn outcome, right? So we're looking at what happens if my company fails or doesn't reach the valuation that I want it to. What else has been working for me during my time in that entrepreneurial life cycle? And for many of us, that would have been that portfolio that I had invested in stocks and bonds along that 3, 4, 6, 7 year period in which I was actively an entrepreneur. So there's one. There's also a behavioral finance outlook that I find very helpful, and that is what incentivizes you to liquidate too early, to not understand your own opportunity cost of capital, either in the markets or in your startup. And that is the lack of an alternative way forward, right? If all of your money is tied up in your startup and you reach Series C and you have some sort of unplanned, unexpected outlay, you may be inclined to go to the secondary market and sell your part of your position at an extremely discounted rate, right? Which generally for most people also triggers a taxable event. So you get double hit in those situations, whereas if you have other capital set aside for those purposes that is actively working, then you can go to that capital that's set aside, that's actively working, use that capital and maintain the maximum position that you already planned for in your own company. So those are the two reasons that we generally recommend, even early on in the capitalization stage, if there's a way to, even if it's you're paying yourself, but you're actually budgeting more money into a diversified portfolio, however you need to get to having just a little bit set aside, I would highly recommend you do that, not only to have it set aside and have it performing in the markets, but to incentivize the proper behavior when you are attempting to value the amount of equity that you have in your company and what you can do with it. So I'll quickly move to outperformance, which will be the last one I'll cover, and then we'll open it up for questions that you may have. So outperformance is where everyone wants to be. That is that late B, Series C, D zone, or if you're not going in the series path, you have such great sales that you can actually begin enriching yourself, right? Either way is a great outcome because you can generate liquidity basically overnight. So at this stage, we are still looking at the same group that we had before, a CPA, an estate attorney, some sort of advisor, right? And if you are so inclined, someone who's helping you look at the markets at minimum. For outperformance, though, you want someone who's looking at the markets and also someone who can tell you about how you should be moving forward with mergers and acquisitions. If you should be looking at IPO, what's reasonable for your company? What's a reasonable outcome? What's an unreasonable one? What do you need to do to prepare yourself for the next step, which could be IPO, could be M&A? And for that, again, all of you who are here right now within 1 degree has someone who has gone through that process and can help you with the ideation phase for what's next for me. What I would recommend there is when you're having conversations with professionals, I would actually connect with those professionals who have experience with mergers and acquisitions that are at your company's enterprise value. So you're somewhere in their actual range. What I've seen fairly often is people will meet with an investment banker who unfortunately is not in their range, and so they can't make the subsequent introductions to ensure that they get all of the entrepreneur gets all the information that they need and all the indicators that they need to make the right decision, right? So a question that I would ask as I was putting my team together is, how many companies at my company's size have you actually sold? Or what are the general outcomes that I should be expecting as I go through this process? And then as they name companies, then they name the enterprise value, you should get a pretty good idea of whether or not they can help you specifically. And if they can't, Seattle's actually a fairly small place for investment bankers, so they probably know someone who has actually spent all of their time within your specific vertical. So who's on my team at the outperformance side? Now I have a CPA and a state attorney, probably someone helping me with investments, and probably someone who has a lot of experience with investment banking. Then you get to the crossover phase, right? That is, Microsoft wants to buy my company, or I'm going to decide to just run this company for the next 30 years and then sell it. All of those outcomes, you are set up to go in any direction because you have all the indicators that you need to protect yourself and the capital value of your business. Running separately from that is the portfolio management piece. And on the portfolio management side, generally in that 5 to 10 years, you're going to have at least one major market move. And so again, you make the case for diversification of any money that you have set aside, and the case for risk managing that portfolio away from the risks that your personal company is exposed to. So as we move through ideation, tangible asset creation, capitalization, and outperformance, there should be two recurring themes that you picked up from everything that I said so far. Number one, it's impossible for you to get to where you want to be if you have no idea where that is. And so take some time. I know you don't have much of that, but take some time, practice some introspection, and then really be looking at a tangible value that helps you get to where you want to be, do what you want to do, and feel how you want to feel as the starting point before you consider any of the other teaming. And then once you have a team, then you can ask all of those questions, right, that will get you there. And then the other thing is, the team is, for most of us, absolutely necessary. We are going to be heads down working on our company nonstop. So we probably don't have time to be way deep down in the Washington's version of the IRS federal code, the federal code, et cetera, et cetera. We probably don't have time to be trying to figure out whether now is a good time to invest in gold, right? We probably don't have time to understand how, if we move from here to California, our home value will be affected if it's transferred to our kids in the event of an estate transfer. So those are the two things that I wanted to really be clear about bringing to you guys is, you do have time to focus on your company, but you also have time to meet the type of people who can help you preserve your wealth throughout these 4 phases of outcomes for entrepreneurs. And I'll leave you all with one other funny anecdote. So we meet a lot of very interesting people in my line of work. And I met someone who has his own family office, has been investing for 30 years. And so I asked him, who's actually in your family office? And he told me several CPAs, I have several lawyers, and several wealth advisors, right? The exact same plan that you heard here is the same thing that all of these extremely rich folks are doing. They are just filling the team with more experts to get more indicators to make better decisions for themselves. So moving from there all the way to where you are now, somewhere in the scope of this, I hope you can make the right decisions for yourselves. Thank you.
Any questions for Skyler? Hang on. We're using a mic so the people online can hear the questions.
Hey, how's it going? Thank you so much for the talk.
Absolutely.
I'm just curious, what are some of the differentiating factors that really can kind of set apart a situation where I need to go the extra step and I need to hire an attorney to be looking at some things? Obviously, lawyers are expensive, get a ton of different paperwork that kind of comes across our desk every day. And, just what are some of the prime factors when it comes to wealth generation that you would say this is the time that maybe it serves as an indicator to have a professional that's involved?
Absolutely. That's a great question. And I would take a step back from there to what we recommend to our entrepreneurs that work with us. And that is at minimum an annual check-in, right? And at the annual check-in, you're asking questions like, over the next year, this is where my company is. What should be tingling my spidey senses, right? With what we do at our company, the left and right limits of what we are doing. And then throughout the year, right, in those moments where you are not quite sure if there's capital at risk in any way, then that's when you make the call. Generally, is people's outlook. But if you haven't had that initial conversation, right, you may not be sensitive enough in the right areas to make that call. So it's actually a lot of prep and education early on that will help you understand where to make that call.
Senses.
You do.
Yeah.
You do. I should write that down somewhere. You need those spidey senses.
Thanks.
Absolutely.
Hey, back here. You mentioned taking some volatility or I guess risk off the table if your assets are all tied up in your company, right? Could you talk through a little bit more about what that would look like to diversify out of your company, sort of how you would do that, and then what are those vehicles that you're diversifying into?
Absolutely. That's a great question, and thank you for asking it. So we start with what we did here for 30 or 40 seconds, right? Depending on how much value your company has, you may be able to create your own lifetime spending endowment in your Series C, right? But for all of us, it's basically the process of getting some sort of capital in cash, be that from the secondary markets or from another method, and then taking that cash and investing it away from whatever your company's risk structure looks like. And so, for example, if you are heavy into cloud computing and you take that capital out and you put 100% of it in the S&P 500, we haven't de-risked to the degree that we should, because a significant amount of the S&P 500's exposure is cloud computing, right? And so this is actually a really specific question that I'm happy to follow up with you on after, but at its most basic, it is, I have value that is now not moving along with my company's value. And over time, generally some considerations are how much is that value yielding through dividends and coupon bonds, right? Because that's another thing that we reinvest in order to keep our portfolio separate from our company's exposure. Thanks. Absolutely.
Oh, thanks all for the talk, Skyler. And I really like the way you characterize wealth preservation as essentially a risk management problem. And so I have a question that relates to when the founder can become the risk themselves. And I have a coaching client who is later in their career looking at retirement, and they've been a very successful consulting engineer, six-figure income for most of their career, should be perfectly well set up. However, he founded a company mid-career, and during the founding process and the development process, he was totally committed a lot of personal resources to it. Company did not succeed, as many don't, we know. And that left him in a position where he's not able to do some of the things that he had hoped to do. So what I'm wondering is how do you advise people in that phase, that when they're, say, ideating and creating the assets, to keep them from overexposing themselves to that kind of risk by investing too much of their personal wealth into it?
That's a great question, and I think a question like that is hard to answer because goes back to that opportunity cost of capital phrase that I mentioned earlier. Ex post facto, you really are where you are, and I assume as someone who's actually advising, part of the work is helping this individual reorient to where they are and resetting those goals live. But as I think about personal capital and whether or not someone should put it into a new company, maybe not the answer that you want to hear, but there's actual tangible value for some folks in terms of taking the biggest shot that they can on where they want to end up. And for those people, they get tangible value from taking the risk and seeing it through, right? Which is why I try to focus more on frameworks rather than being prescriptive, because if there's a fulcrum point, right, there are things that this person absolutely wants to do during retirement and things that they would like to do. The things they would like to do may not exactly be those things that they think about, rather than, I really should have taken the shot. I didn't take the shot based off the advice that someone else gave me. Now, no matter what I do, I'll be thinking about and fixated on the fact that I wasn't true to myself in those moments. So to sort of combine your question with the question that we had from the back there, that's why I would recommend, as you move through the cycle, you're setting aside capital that will be there specifically for retirement, whether that's 50, 35, 65, and that's really all it's for. And then you have maybe another piece of that portfolio that's earmarked for these sort of moonshot type of investments, because at the end of the day, people are just different in terms of how they approach risk. So hopefully that didn't sound like a total non-answer, but it's tough to say not knowing the individual's personality.
May I?
Sure.
Yeah, thank you for the talk. And I have two questions. You can choose which to answer, or maybe both.
Okay.
So the first thing is, what would you like to change in your personal plan if you can come back in time? Like, which decision you would do differently now?
Great question.
And the second one, I don't know, maybe consider investment advice, but I hope not. Like, which kind of assets you'd like to advise to pay attention at this time? I mean, where would you invest now? As just not advice, but yeah.
Yeah, for my personal portfolio, of course. So your first question has a hilarious answer in the spirit of radical candor and authenticity. One thing we recommend in the risk management world is sometimes you may not have the right outcome, but as long as you did the right amount of planning and study early on, then whatever happens, at least you did the right amount of planning. I have 3 kids. I had no idea how expensive it would be to get all those kids in daycare. And I love the kids. I would never change anything. But not doing the amount of research on something that for many people in King County, right, is equal to or more than their mortgage payment was not the right move. So in terms of my personal story, I would have done more planning, set more cash aside to get all of my kids in daycare. That's my honest and authentic answer there. In terms of what I would recommend, so if you're at that $10 million range, right, 20 million, 100 million, that's a completely different conversation than the conversation that most Americans are having. And so I'll shift more to what should most Americans be thinking about, using that 401k as an example. So generally you want to be investing in funds that have a very low rate of fees, that track some sort of index that's known to be connected to some sort of large nation state's performance. So most people will talk about the S&P 500 fairly regularly, right? If you look at your 401k today and you see that you're paying a percentage point in fees to have access to the S&P 500, then it's probably because you didn't have a conversation with someone who's in the 1 degree zone of your personal board of directors. All of those fees, in my opinion, should be extremely low so that the fees don't diminish your performance over time. So obviously the US has done well and outperformed many countries during the post-COVID recovery. It's outperformed many countries in the inflation space as well. So I believe the US is absolutely, for those of us who are personally investing, for myself, I'll speak for myself, I believe the US large cap is still a great place to invest. On the flip side of that, Barclays 1 to 10 aggregate bond index, right? If you're looking at bonds, it's very difficult for most normal people to figure out what duration they should be at. And so taking a wide spectrum will at least get you that security of having access to bonds. So whether that's 10 and 90 or 90 and 10 is a much more in-depth discussion that sounds a lot like investment advice, so I won't go there. But I think there are some great options in the index world that would be helpful for everyone. Absolutely.
Question online. It says, can you give more of an overview of the QSBS and what factors make a company eligible versus not eligible?
So that is a great question, but it's a moving target. So that's something that I would have with my personal board of directors at minimum. Any CPA will be able to give you that answer. You can also actually read the IRS code that describes it today, but assuming someone's logging into the YouTube a year from now, the answer may be different. So it's a very long readout, and I'll make sure that I don't mess that up by recommending that you go and look at it yourself.
I also have a question from YouTube. What are some whose phone is that? What are some key legal and financial steps that founders should take as they approach an exit event, such as acquisition or IPO, to maximize their own wealth protection?
That's a great question, and I think in terms of the legal side, if you have a great investment banking team and your own personal board of directors, there should be two groups of people looking at the legality of everything that's occurring, right? So normally, at least in this town, we don't see many significant M&A incidents, right? Because we have a very large bench of experts there. So that takes care of the legal side. Financially, I would say, be very wary of either over committing to a sale, one, or two, staying fully invested over the long term for the reasons that you mentioned, right? So over committing in a sale is one of those behavioral finance things where you need to figure out long before the sale how much value you are willing to take out of your own company and be okay with in perpetuity. So a lot of this stuff is actually more, rather than statistical based analysis of what's happening with your company, it's your own introspection giving you the answer to that question, and then you taking it to a wealth advisor or you asking the follow-up questions to people in your team. That answer is going to be different for everyone. I would say the transition value between when we go from our company's capital to cash in our bank account can be significant based off, again, the fees that you're paying, right? So fees for a wealth manager, fees for bankers. So I'll be very cognizant of that too. And just like you were getting folks to work on your roof, I would have those conversations early and often, and then make sure I was fully informed before I made the final decision on coverage.
Let's say you're between the ideation and tangible asset phase, and you're working on building out that team. And I guess my question is, let's say you've decided that you need a co-founder, and you've invested a pretty significant amount of your personal wealth. How can you bring in a partner prior to a larger scale investing in a way that protects the wealth that you've invested from the risk of, having somebody else join? Or do you have advice on who I should be talking to or what I should have prepared to limit the risk before even considering bringing in a partner?
I'm happy to have that conversation offline in detail. I would say that there are always second and third order effects to bringing on a partner. And one of them that we don't often think about is future value of the company and how your partner's decisions can affect future value, right? So if that's the most significant outcome that's possible, I think the heart of the question is this the right partner? And then all of the other questions, are secondary and tertiary after that. I don't have that answer, but I can talk to you about, cap table space and considerations there offline.
I have another one from online that brings up, in this space, we have a lot of very early stage startups that are bootstrapping their startup company, and this question sort of leans into that. How can entrepreneurs maintain a strong personal credit profile while managing the financial challenges of a startup?
That's a great question. And when you say personal credit profile, I assume you're talking about your credit rating here. That'll be my assumption. And I have great news there. It's easier now than it's ever been to do that, right? The first piece of it is, am I actively monitoring it? I don't have any recommendations for that, but I can tell you that there are several free and available methods for actively monitoring it. And then the other thing is, and it goes back to what I said originally about opportunity cost of capital, if it's business related, right, we want to keep that completely separate and distinct from what we are doing in our personal portfolio, but we also want to budget like we would for our business, right? And that usually means being in a pretty good cash position. So as you look at, long term where you want your credit to go, NerdWallet and all of these other spots have very specific advice on raising it by 5, 10, 15 points. And I would defer to them. But in a general sense, it really starts with monitoring and knowing the outcomes from the active decisions that you make.
Anyone else before we let Skyler go? Anything on YouTube over there, Franny? No. I think we've had some overlapping questions, so we don't want to waste your time with those. So thank you very much for coming today.
Thank you. And thank you for being here.
Relations. Sign up today, and we'll see you next week. Thank you.